What if I told you that two people with identical salaries, working at the same company, investing the same amount of money every single month, can end up with portfolios that are hundreds of thousands of dollars apart after a decade? Not because one of them is smarter, not because one of them has a secret Wall Street connection, or some fancy hedge fund manager whispering tips in his ear. The only difference is what they're holding. And today, I'm going to show you exactly what that winning portfolio looks like. I will break down 4 unique ETFs that are quietly beating the vast majority of investors in 2026, and the whole setup can be done in just a few simple steps. Stick around, because by the end of this video, you'll have a complete investing blueprint tailored to your own goals and objectives. If financial freedom is one of your goals, this is the video you do not want to miss. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Before we get to those 4 ETFs, I need to talk about the 2 things that are probably already in your portfolio that are quietly dragging you down. And I'm not trying to be harsh here. I'm trying to save you years of wasted returns. These are the investments that sound responsible, that your financial advisor has probably recommended, and that feel safe on paper. The problem is, safe and profitable are not the same thing, especially in today's market. The first culprit is bond ETFs. Now look, I understand the original logic. When the stock market takes a hit, bonds historically held their ground. The idea was that if you had a chunk of your money in bonds, a major crash wouldn't wipe you out entirely. That's a reasonable goal. The problem is, the execution is completely broken right now. Over the past 5 years, bond ETFs have seriously underperformed when compared to their performance a few years back. You read that right. You parked your money in something specifically to keep it safe and provide profits. And then it decided to step on the brake pedal. In a world where inflation is eating away at your purchasing power every single year, making a 3% return and a so-called safe money isn't complete protection. That's just a slower way to fall behind. The second culprit is international ETFs. And before you push back on this, hear me out. Investing geographically made total sense back in the 1970s and 1980s. Before the internet existed, companies were genuinely limited to their home markets. If you wanted exposure to consumer spending in a foreign country, you actually had to invest in companies based there because those were the only businesses that could reach those customers. That world no longer exists. Today, people across Germany are ordering from Amazon. People in Asia are running Microsoft software. People in Brazil are stopping at Starbucks. The biggest companies on the planet have become global enterprises, capturing market share from every corner of the world. So when you buy an international ETF trying to get that global exposure, you're actually duplicating something you already have, and the returns confirm it. Most of the popular international ETFs in the world have averaged just over 5% over the past 5 years. Every single ETF we're about to cover today delivers at least double that. The math just doesn't support international funds for a long-term growth portfolio in 2026. Now let's build the portfolio that actually works. 4 ETFs, each playing a specific role, working together as a system. Let's go through each one. ETF number 1 is your foundation. This is SPYM from State Street or VOO from Vanguard. They track the exact same index, the S&P 500, so just pick one and stay consistent. The S&P 500 is a collection of the 500 largest publicly traded companies in the United States. And the beautiful thing about it is it self-manages. Strong companies automatically grow their position in the index. Weak companies eventually get removed. You don't have to think, research, or make any decisions. The market does the filtering for you. Since SPYM launched in 2005, it has averaged around 11% per year in price appreciation alone. Add dividends back in and reinvest them, and that number climbs to roughly 14% annually over the past decade. Through the dot-com crash, through the financial crisis of 2008, through the pandemic sell-off, through every single scary headline that had people panic selling, this index has come back every time and pushed to new all-time highs. This is your anchor. Everything else in the portfolio builds around it. Top holdings include Nvidia, Apple, Microsoft, Google, and Berkshire Hathaway, companies that have genuinely earned their place at the top. ETF number 2 is your growth engine. This is QQQM, Invesco's lower-cost version of the legendary QQQ ETF. Both track the NASDAQ 100, which is the 100 largest non-financial companies listed on the NASDAQ exchange. QQQM carries an expense ratio of just 0.15% compared to QQQ's 0.18%. Same index, but lower fees. Better outcome over the long run for buy and hold investors. Now, I know that QQQM just launched in late 2020, but QQQ has been running since 1999, and it tracks the exact same index, giving us a rich history to analyze. Over the past decade, QQQ has averaged over 20% annually with dividends reinvested. That number is extraordinary for a broad ETF. The top holdings are exactly what you'd expect in an AI-driven decade. Nvidia, Apple, Microsoft, Google, and Meta. This fund is heavily weighted toward technology and artificial intelligence, which is precisely where the next wave of economic growth is being generated. The trade-off is volatility. In 2022, QQQ dropped over 32%. That's a stomach-dropping decline. But here's the reframe. If you're years away from needing this money, volatility isn't your enemy. Volatility followed by recovery is how compounding works in your favor. The bigger the dip, the bigger the rebound multiplier when you're consistently buying in. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. ETF number 3 is your downside protector. This is SCHD, the Schwab's dividend-focused value ETF. And this one might surprise you because its recent performance looks underwhelming on the surface. SCHD has lagged behind the flashier tech-heavy funds over the last few years, and that's actually exactly why it deserves your attention right now. SCHD's top holdings include Texas Instruments, Qualcomm, Chevron, Coca-Cola, Pepsi, and Procter & Gamble. These are not exciting technology companies. They are boring, recession-resistant businesses that people keep spending money with regardless of economic conditions. People still buy groceries, still fill up their gas tanks, still drink coffee whether the economy is booming or crumbling. Here's the critical catalyst for SCHD in 2026. Federal Reserve leadership has transitioned. That means if inflation improves, interest rates are expected to decline meaningfully. When that happens, the trillions of dollars currently sitting in high-yield savings accounts, earning 4 to 5% guaranteed, will suddenly be earning far less. Those investors will need a new home for that money, somewhere that still generates cash flow above inflation. SCHD, currently yielding around 3.4% in dividends, becomes exactly that destination. Over a 10-year window, including periods when tech completely dominated, SCHD has still averaged around 12.5% annually, with dividends reinvested. When market cycles rotate away from tech, which history tells us always happens eventually, SCHD is positioned to capture that rotation in a major way. And during a crash where tech names drop 30%, SCHD's boring recession-proof companies barely move. Your portfolio remains intact while others desperately wait to recover. ETF number 4 is the one that surprises almost everyone, and it's become one of the most exciting additions to this structure. This is SPMO, the Invesco S&P 500 Momentum ETF. Here's how it works. SPMO selects the 100 companies within the S&P 500 that have demonstrated the strongest price momentum over the trailing 12 months. Then, every 6 months, it rebalances automatically, kicking out companies that have lost momentum and rotating into those that are building momentum. The expense ratio is just 0.13%, which is remarkably low for something this dynamic. The reason SPMO is called a unicorn is because it delivers growth comparable to aggressive ETFs while absorbing downturns much more gracefully than you'd expect. In 2022, when QQQ dropped over 32% and even the broader S&P 500 fell around 18%, SPMO declined only 10.5%, less than half the damage of the full market. Yet since its launch in 2015, SPMO has averaged over 18% annually. That combination of high upside and resilience in downturns is genuinely rare. Current holdings include Amazon, Nvidia, Meta, JP Morgan, Walmart, and Costco, a notably different mix from most pure growth funds, because it adapts to wherever market momentum is actually building, twice a year, without you lifting a finger. Now let's talk about how to actually put these four together based on where you are in life. 3 scenarios, 3 different allocations. If you're far from retirement with stable income and you're comfortable with some volatility, run this. 30% SPYM as your foundation, 25% SPMO for adaptive momentum, 25% QQQM for aggressive growth, and 20% SCHD for income and protection. Keep 3 to 6 months of living expenses in cash outside this account entirely. If you're roughly 10 years from retirement and you want the balance between growth and protection, shift it to 25% SPYM, 25% SPMO, 20% QQQM, and 30% SCHD. Keep a full 12 months of living expenses in cash outside the account, possibly in a high-yield savings account. If you're already in retirement and living off your portfolio, flip the weighting towards stability and income. 50% SCHD, 25% SPYM, 15% SPMO, and 10% QQQM. Again, I will consider keeping 3 full years of living expenses in accessible cash outside the investment account. My go-to for this is usually high-yield savings accounts. The underlying logic stays consistent across all 3 versions. You have a foundation that tracks long-term market strength, a growth engine capturing the decade's biggest technology wave, a defensive income layer that holds steady when everything else shakes, and a momentum component that automatically realigns itself toward what's actually working right now. Most people overcomplicate investing because fear drives them to keep tweaking, keep researching, keep second-guessing. This portfolio takes that temptation away. You're not trying to predict the next hot stock or time the perfect entry point. You're constructing a system that's built to handle whatever the market throws at it, whether that's an AI-driven bull run, a rate-driven rotation into value, or a sudden market correction. Each ETF plays its role regardless of which scenario unfolds. This setup can be done on any good brokerage account. Automate the monthly contributions so you never have to think about it. Turn on dividend reinvestment so every dollar those holdings generate gets immediately put back to work. Then step back and let time do the heavy lifting. The single biggest advantage retail investors have over hedge funds and institutional traders is time horizon. Use it. This is your blueprint. 4 ETFs built for 2026, designed to outperform. Now it's your decision if you want to make it happen. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Listen, if you want to know the 5 best Fidelity index funds to buy and hold for life, or the 5 best high-yield ETFs for monthly dividends with zero NAV erosion, check out the videos on your screen right now. Thank you, my friend.